Welcome to ACCA Academy YouTube channel. If you are coming across my lecture for the first time, please don't forget to like the video. Also subscribe to the channel so that you don't miss my upcoming videos. To my returning subscribers, I say thank you for being part of this channel. The connected parties transaction in capital gains tax. Connected persons transactions in capital gains tax. Connected person transaction is the transaction in which one person has control over the other. Connected person is a transaction in which one person has control over the other. It's a transaction in which the person making the disposal and the person who acquires the assets are connected. The person making the disposal and the person who acquires the assets are connected. Examples of connected persons include the following are the examples of connected persons. Number one, husband or wife. Husband or wife or relative of the husband or relative of the husband or relative of the wife. So these parties, they are connected. So when you are computing the capital gain tax, if you discover that the connected parties are involved, I've told you that you are going to disregard the consideration of the asset if the consideration is less than the market value. Then you therefore use the market value. Number two, a trustee of a settlement is connected with the settler of that settlement, with the settler of that settlement, and with any person connected with the settler, and with any person connected with the settler. A trustee of a settlement is connected with the settler of that settlement and with any person connected with the settler. Number three, a person is connected with the person with whom he is in partnership and with spouse or relative of that person. Number three, a person is connected with the person with the person with whom or to whom they are into partnership. A person is connected with the person to whom they are into partnership and with spouse or relative of that person, and with spouse or relative of that person. Number four, a company is connected. A company is connected with another company, with another company if any of the following holds. Number one, the same person control both. The same person control both. The same person control both companies. Number two, one is controlled by the person who has the control of the other. One is controlled. One is controlled by the person. By the person who has the control of the other. Who has the control of the other. Number three, a person control one company and the person connected with him control the other. A person control one company. A person control one company and the person connected with him control the others. And the person connected with him control the other. So, number four, the same group of persons control both. The same group of persons control both. These are the examples of connected persons relationship. So I've told you that where transaction take place between the connected person, the consideration of the asset shall be disregarded if it is less than its market value. Where the consideration of the asset is less than market value of the asset, you are going to disregard the consideration of the asset and then use the market value. Example, in April 2024, Dr. Mason acquired the house at a cost of 60 million naira. Other acquisition expenses incurred were 100,000 naira for legal fees and 200,000 valuation fee. On November 30, 2024, a duplex was constructed in the excess space at a cost of 12 million naira. On June 1st, 2025, the duplex was sold to Uncle Jimmy for 16 million naira. The actual market price was 20 million naira, and the value of remaining property was 68 million naira. On 1st of January 2026, Dr. Mason sold the remaining property for 72 million naira after paying the following expenses. A. Improvement prior to sale, 100,000 naira. This is the cost incurred in improving the assets prior to sale. This will add to the value of the asset. So you are going to treat it as part of the cost of the asset. Estate agency fees, 400,000 naira. These are incurred in selling the asset. Legal fees, 120,000 naira. Advertising, 240,000 naira. Required. Compute the capital gains tax for the relevant year of assessment. So, in answering this question, you put the name of the entity, Dr. Mason. So, the requirement asks you to compute computation of capital gains tax for, if you go back to the question, You have to compute the capital gains tax for the relevant year of assessment. Examiner will put for the relevant year of assessment. If you put for the relevant year of assessment in your title, you are not going to earn a single mark. No mark will be awarded to you. You'll be awarded 0 marks. So you have to state your year of assessment, and capital gain tax is accessible on actual year basis. Now, the year of disposal is the year of assessment. When was the asset sold? On June 1st, 2025, the duplex was sold to Uncle Jimmy. Duplex was sold in 2025. That means one of the year of assessment is 2025. Then January 2026, Dr. Mason sold the remaining property. Another one was sold in January 2026. That means the year of assessments are 2025 and 2026. So you put for 2025 and 2026 years of assessment. This is not accessible on preceding year basis. If you put 2026 and 2027, so it is wrong, and you still earn 0 mark for that. So please put your year of assessment. Now, the asset that was sold, year of assessment, the first year of assessment is 2025. The asset, one of the assets were sold in 2025. Remember, the basis period for capital gains tax purpose is actual year. So the basis period will run from 1st of January 2025 to 31st of December 2025, actual year basis. That is the basis period. Now, assets that were sold, sales proceeds. How much was that asset sold? The one that was sold in 2025. We were told on June 1st, 2025, this duplex was sold to Uncle Jimmy for 16 million. Uncle Jimmy is connected to Dr. Mason. They are relatives. Uncle Jimmy is a relative of Dr. Mason. So, and since they are related, that is to show that this transaction is a connected party or connected person's transaction. So, now I've told you that where the sales proceed is lesser than the market value of the asset, that you should disregard the sales proceed. Now, the sales proceed is 16 million. The actual market price was 20 million. So that means market price is what we are going to use, not the sales proceed. Market value of the duplex. Market value of duplex. How much was the duplex sold? The market value is 20 million. 20 million. 20 million. That is the market value of the duplex. Remember, this is not a partial disposal. The question is structured in such a way that you will think that the question is sold in part. It's not a partial disposal. So, this one, they bought a house for 60 million. The property itself is the house that was acquired, which is a single asset. And then the other acquisition, they incur the following as an acquisition expenses. Then in that house they bought, they were left with some space, and they now construct a duplex. A duplex was constructed in the excess space. The space they now have in that property, they constructed a duplex there. A duplex is also a separate property. So house is a separate property, and duplex is also a separate property. So it's not a single asset. It's not a single asset. So don't treat it as a partial disposal. So a duplex is what they were now sold now. So we were told on June 1st, 2025, the duplex was sold to Uncle Jimmy for 16 million. The actual market price was 20 million. So, and the value of the remaining property was 68 million. This is the fair value of the remaining property. You know, the house will still be left. That is the fair value of this house that was 60 million. The fair value is now 68 million. That is the meaning. So on January, okay, that is for duplex. Duplex, the market value is 20 million. How much is the cost of the duplex? So on November 30, 2024, a duplex was constructed in the SS space at a cost of 12 million. So less the cost of the duplex, less cost of duplex. The cost of the duplex is 12 million. If you remove the 12 million from the market value of 20 million, then you have 8 million. That 8 million is the capital gains. Capital gains. Capital gains of 8 million. Therefore, capital gain tax at 10%. The capital gain tax, the rate is 10%. Please watch my first video for better understanding. I've given the format. I've explained the various concepts required to understand the capital gain tax. So go and watch it, please, for better understanding. 10% of 8 million, that would be 800,000 naira. That is capital gain tax payable in 2025 year of assessment. Then in 2026 now, 2026 year of assessment. Now in 2026, on January 2026, Dr. Mesa sold the remaining property for 72 million after paying for the following expenses. The remaining properties were sold for 72 million. So we have, the basis period for 2026, if the basis period is actual year basis, 1st of January 2026 to 31st of December 2026. That is the basis period. So the sales proceed now. Sales proceed. The remaining properties were sold for 72 million. 72 million. Now, less allowable selling expenses. Allowable expenses. I've told you the allowable expenses here are the expenses incurred for the purpose of selling the asset. The expenses incurred in selling the asset. Now, what are the expenses incurred in selling the asset? So, you were told the remaining properties, Dr. Mesa sold the remaining property for 72 million after paying for the following expenses. Improvement prior to sale. I've told you the cost incurred in improving the asset before selling it. We add to the value of the asset. So it should be capitalized as part of the cost of the asset. So you are not going to expenses as a selling expenses are part of the allowable expenses. So this we add to the value of the asset. You treat it as part of the cost of the asset. The estate agency fees of 400,000 was incurred in selling it. Estate agency fee, and that amounted to 400,000. Back to the question. Then we also have legal fees, 120,000 naira. Legal fees of 120,000 was incurred in selling the assets. So we have legal fees. That is 120,000 naira. You also have advertising, 240,000. The asset was advertised before it was sold, and they incurred 240,000 naira is selling on advert. So advertising, that is 240,000 naira. So when you sum up this, 400 plus 120, that is 520,000. 520,000 plus 240,000, that is total 760,000. 760,000 naira. If you now deduct the 760,000 from 72 million, just subtract it from 72 million, then you have 71,240,000. 71,240,000. That is net sales proceeds. Net sales proceeds. Now less the cost of the asset. Less cost of assets. And how much is the cost of that house, of the property, the cost of the property? Back to the question. At the genesis of the question, it's not the fair value you need, the actual cost. In April 2024, Dr. Mason acquired the house at a cost of 60 million. Cost of acquisition cost, $60 million. Back to the question. Other acquisition expenses incurred were 100,000 for legal fees and 200,000 naira for valuation fee. We have legal fee 100,000. We also have valuation fee, that is 200,000 naira. Back to the question. On November 30, 2024, a duplex was constructed in the estate space at a cost of 12 million. So this is sales of duplex. Remember the first one. Let me put duplex. The first asset that was sold here is the duplex. Then the later one, which was sold, is the property, the remaining property. Or let me just put property or house. Property or house. That is for the second one. So then if you look at this, we have improvement prior to sale, 1 million. 1 million naira was incurred in improving the asset. Improvement. That is 1 million. Now let's add up all the costs. 61.3 million. If you sum up this, 61,300,000. Now let's subtract it from 71,240,000. So we have 994,000. 994,000. Then 71,240,000 minus 61,300,000. We have 9,940,000. 9,940,000. 9,940,000. That is capital gains. Now the capital gain tax now payable now. Capital gains tax payable at 10% now. 10% of 9,940,000. That will be 994,000 naira. 994,000 naira. This is the solution to the question. So that is the end of this video. In my next video, I will consider the treatment of hire purchase in capital gain. That is computation of capital gain tax involving hire purchase asset. Then I will also consider the rollover relief. Then I will as well consider partial disposal. Thanks for watching ACCA. Please like the video.